to all the earnings analysis, let's quickly tell you what's happening on global screens. And as the headline just pointed out, the color is still very much red. You've got oil as the key culprit right now. We're not talking China. It's oil for at least the last couple of hours. And that's the picture. Some sharp losses now building up on Wall Street. The slide is getting a little deeper. And we've had a major risk aversion move even in European markets. So most of those indices have lost between 1.5% to 2% as well. And if we bring oil up on the screen itself, then it's looking very ugly once again. 5% down. All this talk about maybe some kind of a bottom coming back in place, well, make that almost 5.5% to 6% on Brent. So it's definitely not looking very reassuring. Mr. Manish Kabra of Bank of America Merrill Lynch joins us on the phone line to help us understand what's really going on. Manish, thank you for joining in. This oil slide, I mean, how are you interpreting the fact that, we're getting such a sharp reaction even in the equity space? Do you think this will pass, or could this be some kind of a round two?
Well, yeah, clearly, like commodities or credit market or stock markets, they're all virtually in recession territory. So we got to ask some fundamental questions here. One is it just a reset of growth outlook, or is it indication of some recession? Now, watching through this, I think there's some long-term secular trends, which are really deflationary in the markets, whether debt levels, deleveraging of the financial sector, poor demographics or aging demographics, tech disruptions, and then all these four in combination are creating a secular backdrop of lower growth. Now, China is the one which has been impacted, but if you look at, if you ignore that long-term secular decline, the short-term, most cyclical arguments have been, we have seen this sell-off because of the U.S. manufacturing, and U.S. manufacturing is getting hurt, not just because of lower oil, but also because of stronger dollar. So we need to see improvement there, and clearly Fed timing not helping here. So broadly, we're watching more closely on the U.S. manufacturing cycle. If that doesn't improve, then this whole episodes of higher, volatile period, being tactical long cash, as in those kind of scenarios will keep working with the global asset allocators.
Manish, what's your sense on how the market is poised right now? In the little bit of a relief rally that we saw in the past few days, was there a lot of short squeeze, or are there still a lot of shorts in the system? And I'm talking more with respect to the equity market here. And what's your sense on the U.S. indices? What sort of levels can we expect in the coming days if oil continues to be as weak or weaker than where it is right now?
Well, if oil continues to be weaker, it's going to impact the U.S. credit market quite strongly. As in, it's already in a recession territory, but it'll get even worse. So watching, to what extent, even in Europe, where asset prices are getting correlated to oil, there would be a proper de-risking in the market. So, as in, where do we find a floor, whether it's a short squeeze or is it something more material? I think a lot of the hedge fund exposure that we are watching is already quite de-risked. So positioning is quite light from short-term players, but long-term investors, they're still long equities, short bonds. I think there's a classic recovery mindset from the long-only guys. So that hasn't changed. Whereas fundamentally, what market is asking now is, are we going to see economic recession?
Okay, sobering thoughts there, Manish. Thanks so much for joining us and giving us your perspective on the fall that once again is really spooking both global equity and commodity trade. On that note, let's come back home.